Hello, this is Dr. Cozette with My Financial Home Enterprises. And today I want to have a discussion with you all about filing status. That is, married filing separately or married filing jointly. I had a client, Keisha Gibbons, reach out to me and ask me, what are the pros and the cons, and why is it that couples, married couples, file separately? Well, there are a number of different reasons why one may choose to file separate returns. And I'm going to go through all of those returns, but I want for you guys to know that in the event that you need to file, or should you have to file a separate return for child support, for student loans, for a tax liability that the other spouse may have with the Internal Revenue Service, there is a form. There is a form. We're going to talk about it. It is called the Injured Spouse Relief Form, and it will save you. Okay. So, in this first part, I'm going to talk about the pros and cons of filing separately. So, the pros, number one, there's some independence. When one couple decides that he or she wants to file a married filing separate return, it allows them independence, it allows them freedom. Maybe two individuals came together and it is time to file taxes, and maybe there's some financial things going on. Maybe it could be one has more income than the other, one has liabilities. I just said that. The liabilities could be student loans, it could be prior debt, it could be other obligations. And so filing separate is a way to protect this individual from not having the other one's tax return garnished. Okay. Itemized deductions. Maybe there's an opportunity for one of the spouses to gain more of their tax refund back or to reduce their tax liability by itemizing. Now, when we think about the cons, when you are filing a married filing separate return, if one spouse is filing married filing separately and doing the itemized deduction, then the other spouse must itemize as well. Okay. So there are some things that you lose out on when you do a married filing separate return. Number one, you lose out on some of the credits that are available to you and the deductions that may be available to you when you separate and do two different returns. You are definitely going to be in a higher tax bracket if you decide to, do two separate returns. He's doing hers and she's doing his. And just because couples do the married filing separately, it doesn't mean that there's something going on with the relationship, you guys. It's usually they're trying to not get caught up with the IRS taking money from the entire family. That's typically what I see. Okay. So the complexity, there is complexity when we file separate returns. When you file a married separate return, you are obligated to include your spouse's information on the return, the name, the full name, the Social Security, and there is a line in there that asks for the spouse's income, their wages that must be reported. Okay, so do keep that in mind. In cases where maybe you are separated, you still must list his or her amount of wages that they made for the prior year. Sometimes we don't always have that number. So we either give a guesstimate or, you can put zero. Okay. But you do have to list their information in your return. So when you file a married filing joint return, number one, it is going to lower your tax rate. Okay. It just offers more benefits when the two of you are putting the return together. All right. When you file married filing jointly, the standard deduction is higher. When you file married filing separately, what they're doing in essence is just cutting it in half. He gets 50, she gets 50 when you do the married filing separately, unless someone decides that they're going to itemize. All right. So you gain access to those credits and deductions that are available to you as a married couple when you file the married filing jointly. And then, of course, it is a simplified filing. It is so simplified. You're not paying more for two separate returns. It's just all around simplified. Now, when two people don't file, There's a shared liability, or excuse me, the cons of filing, married filing jointly. There's shared liability when there's outstanding student loans, there's outstanding child support, and the two of you file that married filing separate return. There's shared liability. If there's a tax amount due of $10,000, the two of you are responsible for that. Whereas if you were to file separately and there was an outstanding amount, the taxpayer who is responsible for that debt is obligated for it. The burden is not on the other person. Okay. Loss of independence. And of course, there's income limitations. When you file a joint return and you are high wage earners, both of you, or one or the other, whatever the case may be, there are income limitations and you begin to start losing some of the benefits that are available to taxpayers, such as your student loan interest. You know, it's all based upon your AGI. And what is AGI? Because that was another question today. AGI stands for adjusted gross income. All right. I'll explain that to you guys in a minute, adjusted gross income. But when you think about whether or not you want to separate your returns, just know if you're doing it for any child support, outstanding obligations that individuals may owe it could be any agency. It doesn't necessarily mean that you owe the Internal Revenue Service. It can mean you owe a state agency. But when you file that return with the Internal Revenue Service, they will keep it. They will do what we call intercept, and they will send it to the agency in which you have an outstanding debt with. Okay, so keep that in mind. But just remember, if you have an obligation, you can file what we call an injured spouse relief. What will happen in that case, you all, is once the return is filed with the Internal Revenue Service, I electronically file it, or your tax professional electronically files the return. You will learn real quick that you will not get your refund quickly, because it's just like sending in some documents. They have to go in and they have to reconcile. They have to notify the agency if it is not the Internal Revenue Service, if it is not, if it's child support, if it's student loans, if it's some relief. It could be you didn't pay your registration for your tags. I see state of California does it often. Whoever the outstanding obligation is, they notify them. They have to manually send them funds over to the other agencies, and then they go in and they release the funds to the taxpayers. Now, something you guys may or may not know. When we enter information into the tax return, we automatically information that is designated to the spouse and designated to the taxpayer. Whoever is on the top, they are designated or deemed as the taxpayer. A lot of times it's the husband, and then the wife is listed below. But whoever the taxpayer is and whoever the spouse is, on the back end, you guys don't see this information, but the Internal Revenue Service knows. So when you give me interest statements, when you give me property tax statements, when you give me mortgage statements, and whoever name is on there and whoever Social Security, that information is assigned in the tax return to whichever taxpayer, whether it is the spouse or the taxpayer. That is how the IRS knows. Let's split up this tax return so that 50% goes over here to the spouse and the other 50% goes to the other spouse. When it comes to divvying up the refund, it is all based upon who had all the wages, the 1099s, the retirement, the Social Security, as well as any deductions. So you can save yourself time and money and simplify things by doing a joint return, you all. You don't have to do the single, married filing single or married filing separately, excuse me. You don't have to do that, okay? So to Ms. Givens, hopefully this addressed your question, and hopefully you have a better outcome or a better rationale as to whether or not you and your significant other should file married filing jointly or married filing separately. And before I conclude this, I stated that I was going to talk about AGI, adjusted gross income. Our adjusted gross income, you all, is the income that we have on our tax return, line number 1 and everything in between. And then if we have adjustments, if we have credits, if we have any type of things that will reduce our income, that is what we call our adjusted gross income. And we refer to it as AGI. So that was a question that came from Mr. Sanford today. And hopefully I addressed that for you. I know I addressed it earlier, but if you have that question, I'm sure that there's other taxpayers that have the same question. So until I come to you guys again, you guys have an amazing day. If you have questions about any of these things that I spoke about today, feel free to send me a quick email. All right. I want to remind you guys that we are at the end of the year. And even if we're not at the end of the year, tax planning is critical, you all. It will save you some time, and it will save you money, and it will save you a headache. It will allow you to sleep in comfort come next year when it's tax filing time. You know, if I say you have a tax liability, you guys come unglued. But we can fix that. We can do tax planning sessions. Now is the time. We have ample time. We have tools in place, resources in place that can allow you to save and not owe Uncle Sam. I can't stress it anymore. And by the way, for those of you that may have gone exempt on your W-2s, W-4s at work, please change them. If you got those bonuses and you went to exempt, please change them. All right. You guys have an amazing one. I'll see you on the next one. Take care. Have an awesome and amazing day.